How do you build a stock portfolio that is robust and that will bring you closer to your goals of financial independence? That's the question that I'll be attempting to answer in this video. Now, this question is particularly important for beginners. If you are just starting a portfolio, maybe you don't know where to start, what stocks are attractive investments, which stocks should you avoid, how do you go about picking an overall strategy? These are all questions that we know we need to have an answer for when we begin, but we don't even know where to start. Trust me, I've been there, and so has every other investor in the world. However, many experienced stock investors still aren't clear on these answers. It's very well known that the average person in America spends more time picking out clothes to buy when they're shopping than picking stocks. That's crazy, right? Something so important for your future and your financial independence, and people are still not willing to spend more time on that. Maybe it's because people think that it's mostly luck, or maybe it's because it's hard to think about these things and it's not an exercise that everyone is willing to go through. Now, if you're completely new and you have no idea where to begin, but you want to start investing as soon as possible, what I do recommend is to begin with index funds. And I know you're probably bored of hearing this. Everyone says the same thing. Park your money into an index fund and you'll match the market and just be fine over the long term. I do think that's sound advice for most people, especially very new beginners. And I don't want to get into it too much in this video. I do have my reservations when it comes to index funds. You can watch some of my other videos where I go more deeply into the subject to try to understand why I have these reservations. If I had to summarize them though, it would probably be the concentration of the top companies in the S&P 500, for example, the fact that everyone is pouring all their savings into index funds every month regardless of valuations, the fact that index funds have practically become a instrument for momentum investing. And I'm sure I could find more things, but for now let's stick to that. Having said all that, this video is mostly meant for investors who are going past the index fund stage and want to venture into individual stocks. Sure, this is an approach where you need to have more information, you need to have more time if you're doing it yourself, but it can be more rewarding, more fun, and also it can be more personal to your own financial needs. So having said all that, I want to go back to the original question, which was, how do you build a robust portfolio? And I really think that the first step to answering that question is a deeply introspective one. You have to find your investment strategy. There are many different ways to invest successfully, but first you have to define what success means to you. And that's why I have a man here. He's looking out into the open nature and he's reflecting to himself, what does success mean to me? For some people, success is beating the market year after year. For some people, success is beating the market year after year. For other people, success is being able to live off the income that is produced by your portfolio. For some people, it's reaching financial independence and retiring by 40. And for others, it's simply having a comfortable retirement. So the question you need to ask yourself is, why are you doing this? What's the point? Now, once you know the answer to that, then you know your final destination. And once you know the destination, now you can zero in on how to get there. You need a strategy. Trying to invest without a strategy is like trying to get to an unfamiliar destination without having a map or directions. A good way to come up with a strategy is to look up at what the successful people are already doing. Up on the screen here is a man called Monish Pabrai. He's a very famous investor. He appeared in many different books. He even wrote one of his own. I first heard of him when I was reading a book called Richer, Wiser, Happier by William Green. And in this book, Monish Pabrai is telling the author that one of the key reasons why he's been so good at stock investing and so successful over time is by copying other people. Well, the actual term he uses is cloning, but all that means is looking at what someone else is doing and copying it. Monish's whole thing here is that you don't have to reinvent the wheel. You don't have to find a clever way to get to your destination and your goals. All that matters is that you get to them. And so what he did is that he studied Warren Buffett, the way Warren Buffett thinks, the way Warren Buffett decides when to buy a stock and when to sell. And then he just mimicked the entire process. Funnily enough, it's Warren Buffett that says that you don't get bonus points when investing for being clever and jumping through so many extra hoops. Actually, the simpler, the better. And the result of all that is that from July 1st, 1999 to September 30th, 2024, Pabrai's fund gained 12.9% annually after fees. This compared to 7.8% over the S&P 500. 12.9% to 7.8, that doesn't sound like a lot on a yearly basis, but trust me, when you add all those years together, it comes up to a massive difference at the end of the 24 years. People like you and I are extremely lucky. We live in a time where gathering data and information has never been this easy. With the advances of the internet and all these books that have been written, now anybody can teach themselves how to become a successful investor. All you have to do is read and listen to what the greats are saying. And trust me, they're saying a lot. People like Warren Buffett and other well known investors, they pride themselves in giving back to the investment community. And what do they mean by giving back? It's not money, it's information. Teaching the newer generation how they did what they did. And so, if you find that information, all you have to do is listen and mimic. Now, that's a lot easier said than done, and I'll tell you why. First, you have laziness. As humans, we rather be scrolling on our phones rather than listening to podcasts or YouTube about finance. Props to you, my friend. Leave a like on this video. You're one of the good ones. But the other thing is that this boom of information and data has also some disadvantages. Too much information can be a bad thing. Now, with the rise of social media and YouTube and X, anybody with a platform and a microphone can give you financial advice and tell you how to invest your money. Guilty. You should still listen to me though. But all jokes aside, with all that information, it's easy for you to fall into the wrong hands, so to speak. There's a lot of people trying to sell courses, a lot of people writing books and trying to sell books. And the best way to sell a course, the best way to sell a book is to promise things that are usually not very achievable, like getting rich very quickly. People fall for that kind of thing because people are not patient and people do not want to work hard. It's understandable, it's human psychology. So there's a lot of misinformation out there, and that can lead to misdirection and years of lost gains and lost money. So what I'm going to do now is I'm going to give you a list of very famous, very successful investors, some of the best investors of all time. And I'm going to kind of explain what their gist is, how they made their money, what strategy they used, and hopefully that can give you some ideas as to which one, click with you. At the end of the day, if you're going to have a strategy that you stick with for 30, 40 years, it has to be something that resonates with you, that you understand, and that you agree with. So first up here on the screen is Mr. Peter Lynch, and I would put him in the category of investors that keep things simple stupid. And I don't mean that in a bad way. He's a hugely successful investor. What I mean by that is that people like him found ways to simplify the investment process, to keep things simple, which, is good at the end of the day. And they found shortcuts as to how to find winning deals in the market. Peter Lynch, he wrote many books that are accessible to beginners, I would say. One of the most famous ones being One Up on Wall Street. And his whole thing is that just by observing the world around you and looking at which businesses are succeeding and which ones are failing, you can pretty much get a good idea of what stocks to invest in or not. So for example, if you see that there's a new Wingstop restaurant around you and you see that it's always full, then maybe that's a good sign to look into the restaurant stock and see, if it's a small company, maybe it's something you want to invest into. Because clearly, if people are looking into it and enjoying it, then, that's the sign of a successful business. He gives other examples like going shopping at the mall with your wife. If there's a store that she particularly wants to visit, then you look up the stock and see that it's a small company. Hey, maybe it's time to invest in that. So that's the type of investment that this guy recommends. Now, other investors that I would put in his category are Joel Greenblatt and Ray Dalio. Joel Greenblatt, just like Peter Lynch, is a value growth investor. He developed something called the magic formula, and all he looks at is two metrics: the PE of the company and the ROE, the return on equity. So kind of similar to what we do at Rated A actually. He looks at the quality of the business, which is indicated by the return on equity, and the relative cheapness of the stock based on a low PE. Then he combines those two factors, comes up with a ranking of the entire stock market, and you pick the ones with the highest score, and voila. Once again, keeping things simple, stupid, but it works. Whether it's Peter Lynch or Joan Greenblatt, both of them have been extremely successful. Ray Dalio, I don't know as well. I know he has a all-weather portfolio where he has allocations to gold and stocks and bonds, every type of investment. Now, this speaks to some people because it's super anti-risk, but it's not something that I personally identify with. Next up, we have people like Seth Klarman. Also in that category, I would put George Soros, John Templeton, and Ben Graham, and Carl Icahn. Now, what do all of these guys have in common? To put it into a few words, they're active traders. Now, they trade on different things. They're not day traders. I would say most of them are value investors at the heart, but they have a much more active role in the market. They try to find bargains and they sell when those bargains become fairly priced. Seth Klarman here on the screen is more of a extreme deep value guy. Then you have someone like Carl Icahn, who's more of an activist investor, so he did it his own way. Sir John Templeton, he's more of a worldly investor. He loved to look at markets that are super out of favor, whether it's, in Zimbabwe or something like that, and then he goes find the gem in Zimbabwe and made a ton of money doing that. So all these guys have really good track records, but it's a much more active role, and it's not something that I want to dedicate my life to. And of course, you have the school of Warren Buffett, the king himself, and I would put Charlie Munger in that category. Although Warren Buffett started like the other ones, he was a cigar butt investor, which means that he loved to find really cheap companies that were on the verge of going bankrupt, but he would basically find the last puff out of them and be able to get a good return on that. But Charlie Munger here managed to convince him over their career that it was a better strategy to find quality companies, buy them at a reasonable price, and then hold on to them for the long term. There's plenty other investors in this category. I would put Dev Kantesaria in there. I would put Guy Spear. I would put Terry Smith, Chuck Akre, and Philip Fisher. All of those guys are at the heart quality investors. What that means is that, yes, they're all value investors. Price does have a big role in the way they invest, but it's not the number one thing that they look at. What they look at is the company itself. They identify high quality companies, and then when the time is right, when the price is right, they strike. All of this is just to show you that there are so many different investment styles. You just have to find the one that fits your temperament. If I have to speak for myself, I have to say that for me, the one that makes the most sense for my personality type is the final category we talked about with Warren Buffett. And there's two different reasons why. The first is quality. Investing based on a company's intrinsic quality just makes sense to me. The reason why I'm a long-term investor is because I know that transactions and activity cost me a lot in fees and taxes, and that will reduce my compounding potential over time. But another reason is that I'm quite lazy. I don't want to be that active. I don't want to have to be looking at my portfolio every day or every week. I know that I'll be way more consistent and therefore way more successful if I just buy companies that can take care of themselves. And that sounds kind of naive, you always have to look at companies. And I do. I check my investments at least once a year. I do a full review of it to see if it has to stay in my portfolio or not. But high quality companies usually stay high quality companies. And companies that are not that great usually stay not that great. And like Monish Pabrai said, why reinvent the wheel? If you know that MasterCard is a great company, why would you go and try to find the next MasterCard? It's right there in front of your eyes. Yes, it's a little bit more expensive, but if you take into consideration how durable this company is and the fact that MasterCard will probably still be highly profitable 20, 30 years from now, then paying a multiple of 38 is not that great for MasterCard. And I'm just talking for myself here. I know it's not everyone's cup of tea, but I love companies that pay dividends. Just like MasterCard here, every year making a dividend payment that is higher than the prior year. Now, I know, don't come at me in the comments. I know dividends aren't always the best way for companies to give back capital to shareholders. I know they are tax inefficient, but when it comes to keeping my own consistency when I'm investing, this really helps that. It's nice to see my passive income growing year after year and knowing that I have a goal and that this will take me to that goal. And there's many different reasons why companies that pay dividends are usually higher quality companies. First of all, they have the profitability and they're able to pay those dividends. So it already eliminates a lot of the junk. But it's also nice to have that extra cash flow when a recession comes and you're reinvesting your dividends into companies that now have lower share prices, so your money is going farther. And the fact that I'll never have to sell my shares when I retire. I can just live off the passive income. That's the goal for me. So now I know my strategy. I want to find high quality companies, pay a reasonable price, and just sit on my hands for years on years, decades even. And I also want companies that pay dividends. It's very simple. I know those two things are very important for me. And those two things are the reason why I'm building Rated A. This entire platform is based on those two things. I want a tool that will show me and remind me which ones are the highest quality companies out there, the ones with A's and B's. These are the ones that I will focus on. And then I also want the tool to give me a signal when the valuation reaches a certain point. That's the entire point of this value rating. It combines the quality of the company with the valuation. And that's it. Figuring out the quality of the company, that's the hard bit. That's where all the work is done. You have to look at the competitive landscape, because if your company is doing well, but competitors can just copy it, well, your company is not going to be generating profits for a very long time. And the whole point of investing and the compounding process is that you want your company to still be generating a lot more profits 10 years, 20 years down the line. That's what creates life-changing returns. Then you have to look at the future growth of the company. And guys, looking at analyst estimates is not enough. These guys, their entire job depends on them being in line with consensus and pleasing Wall Street. They're always going to say what's beneficial to the big banks. And finally, you have to look at risks. What events that are not happening right now, but if they did happen right now, they could have a really big impact on the company's competitive position and the future growth. You have to focus on that. And that means thinking of everything that could go wrong with your investment. So you have to think of all three things really thoroughly. So it's not an easy process. It takes time. But once you have that, then all you have to do is monitor the price until it comes down enough to be an attractive investment. And if we look at the track record of the quality ratings, well, so far, so good. Companies with a rating of A, the highest quality companies, have been performing better on average than C's and D's and F's. So far, so good. And I know for now the sample size is extremely limited, but it's a start. And as the sample size grows and grows, then we'll be able to see if the theory actually holds. If you want more information about these quality ratings and how I come up with them, they're all available here under the ratings tab on the homepage. So for now, everything that I've said sounds good in theory, but how does it actually hold up in practice? Well, that's the entire point of this portfolio. I'm putting my money where my mouth is, and I'm investing most of the company's money, which is most of my net worth, into these strategies that I employ on Rated A. As a matter of fact, I am using my own tool to make my own investments. So you could say the incentives are aligned. I'll let you pause and have a look at the entire portfolio. I'm not going to go through every single position in this video. If you're curious or have any questions about the companies that I own, you can leave a comment below and I'll gladly answer any questions. Or I can also make a dedicated video for these companies in the future. But yeah, I'm excited about this. It's a public portfolio. My performance is out there for everyone to see. There's an activity tracker for everyone who's a member on Rated A. You can see exactly when I make buys or sells. And we'll be tracking the performance over time. Every quarter, I'll be giving an update here on YouTube as well. And we'll see how this strategy performs over time. So make sure you subscribe to this channel to follow and be part of this journey. And I'll see you in the next video.